Hello everyone. This example illustrates the profit maximization process that any company under perfect competition follows. So suppose that you are giving the following information. You are given the total cost function, which is right here. Now notice is composed by a fixed cost of 5 and a variable cost of q squared, right? You are also given the price for the good or service that this market produces. And remember, under perfect competition only, because every company is a price taker, the price is fixed. So there is nothing the company can do to charge a price either above or below. That's the meaning of this bar, above price, which means is given. And then, based on this information, you're told to find Q star, in other words, the quantity of production that maximizes profit, and pi, which is a very common representation for economic profits in economics. So, how do we solve this? Well, remember, let me do a couple of lines here so that you distinguish what the inputs are, and here we're going to start developing the solution. Remember, the first thing that you need to know and you need to do is to say, okay, the profit maximization rule under perfect competition is that marginal revenue has to be equal to marginal cost. So that's basically the initial point of every problem. So how do we know what marginal revenue is? Well, remember, under perfect competition, always marginal revenue is equal to price, because for every unit, every additional unit the company sells, they get price, P, which in other words is equal to $20. Now what about marginal cost? Remember, marginal cost, the calculation of marginal cost requires some calculus, and I am not going to assume that you know this. So again, this for those of you that have some mathematical background, the derivative of the total cost function with respect to Q is equal to 2Q right here. So I use this function, I take the derivative with respect to Q, and I find that the marginal cost is equal to 2Q. So once again, in homework, in exercises for exams, I am not going to ask you this part. I am just going to give you this. The marginal cost is equal to 2Q. But you still need to know, well, what to do next, which is, again, equating this marginal revenue to marginal cost. So let's do this. You say, okay, marginal revenue, which is equal to 20, has to be equal to 2 times Q. So if you solve for Q, you are going to get that Q is equal to 10. Q star, the one that you were asked right here, is equal to 10. The profit maximizing production level for this monopoly is 10. This could be 10 units, 10 million units, or any other unit of measure. But we still need to figure out what the profit level is. So remember, profit levels, which in this case depend on Q, are equal to total revenue minus total cost, the standard formula. But of course, this is equal to P times Q, the amount you charge, which is $20, times the amount you are selling, the optimal amount, minus total cost, which we know is right here, the total cost function, minus 5 minus Q squared. So all we need to do, of course, this is Q star. All we need to do is to make the substitutions. P, which is equal to 20 times 10 minus 5 minus Q squared, which in this case is 10 squared. So you compute these numbers, and this is going to give you $200 in profit minus 5 minus $100 of variable cost, and this is going to give you a profit level of $95, right? So here you have the solution for profit maximization under perfect competition, which is the example in your book. But once again, I think a quick explanation could help clarify a few of the important issues like this one. You need to apply the golden rule, And then how to calculate profit. All you need to do is to remember the basic definition of profits, which is total revenue minus total cost. Okay, I hope this helps. Let me know if you have questions.